Happy Friday, and thanks for joining us today. If I can first start our discussion with the economic picture through China. Of course, we did get the export numbers earlier on in the week, inflation reading as well. What is this telling you about the world's second largest economy?
Sure. Thanks, Emily. I think based on the latest data, it still shows that the overall Chinese economy, the growth momentum remained relatively weak. We did have some bright spot when it comes to export, but in terms of the overall domestic spending, it is still quite weak. You mentioned earlier that over this weekend, we'll get a collection of data. We'll also be heading into a long weekend in the China mainland where they will celebrate Mid-Autumn Festival. This could also give us another latest snapshot in terms of the consumer spending confidence. I would say overall, it seems that the market are a little bit concerned about the weakening of growth momentum. But on the other hand, we have seen quite a few reports on the potential policy that could come through, such as potential acceleration of the government bond issuance, as well as the potential mortgage refinancing, which may relieve some of the spending as well. So at this moment, given how depressed the valuation is at right now, it is possible that if we get a coordinated easing or stimulus measures, coupled with the official start of the Fed cut cycle, it is possible that we can stage a small rebound, assuming this type of stimulus measure are actually implemented effectively.
Can you help us to make some sense of the strength that we're seeing across the China techs? Of course, Alibaba, Meituan, very much consumer focused. The likes of Alibaba, we're seeing this household name finally, mainland investors getting a chance to buy into this stock. Do you like Alibaba? And look at the strength coming through from Meituan. The shares up 3%.
That's a great question in terms of the outperformance of these tech stocks listed in Hong Kong, especially when you compare to the onshore market, which remain relatively depressed. I think there are a couple of reasons why we see the divergence. The first one is fundamental. What we notice is that on a year-to-date basis, the earnings estimates on these offshore listed, often internet-driven consumption names continue to be revised higher and higher, partly due to this divergence in consumption. And on the flip side, if you look at the onshore market, which tends to focus more on the traditional consumption method, their EPS estimates has continued to be revised down. So there is a fundamental reason. The second one, I think you also brought up earlier in the session, that we recently had a revamp in terms of the eligible stocks in Stock Connect, and some of these tech stocks are now being added for the first time. So in the very near term, you have a new pool of investors willing to allocate their capital in a very specific sector, despite the overall challenge on the index level.
Data-wise, Jason, how close are we to a recovery? Or do you think this is the new normal for China, 5% growth?
I think that's a great question, because if you look at the activity number we have seen so far, they are not necessarily meeting the official 5% target. But at the same time, we have heard policymakers repeatedly committed to the official growth. So our expectation is that for the rest of the year, there should be more supportive measure coming through. I think the key challenge is that how can the policymakers present a coordinated way such that the market can gain more confidence? Because individually, they may not necessarily be enough to achieve the 5% goal. But if you can have a compounding effect, then perhaps the boost to confidence will be more pronounced.